So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, is selling in the money or out of the money options safer? And so what do we mean by in the money or out of the money? Well, if you're selling option contracts, we're talking about the relationship between the strike price and the current stock price or current ETF price of the underlying. So for example, if a stock is trading at $100, you could sell an out of the money call option at $105. Or an out-of-the-money put option at $95. So both of these strike prices would be out of the money on their respective ends. In-the-money contracts would be if you reversed the calls and puts. And so if a stock is trading at $100, you might sell an in-the-money put option at $101, and you could sell an in-the-money call option at $99. Again, that's if the stock is trading at $100. So to get back to the question, is it safer to sell in the money or out of the money? Well, it's all relative based on the credit and the premium that you took in from selling those option contracts. Sometimes we do sell option contracts at the money. And in that case, we are selling strikes that are very close or maybe even slightly in the money compared to where the stock price is. But in exchange for doing this, we collect a massive premium for selling those option contracts, which then moves our break-even point far away from where the stock is trading at the current time. So if we are selling options near at the money or slightly in the money, that doesn't necessarily mean we're taking on more risk. And in some cases, it could actually mean that we are taking in higher credits and could see potential profits come in a little bit sooner. Generally, people like to sell options out of the money, but there is a distance so far out of the money that it doesn't make sense to sell options, typically around the 5 deltas on either end of an option contract spread. It's probably too far out of the money to generate reliable, consistent returns over time because you're selling premium that's too cheap. So you do have to come closer to at the money or start selling options at the money or near at the money strikes and collecting bigger credits. So hopefully this helps out. As always, if you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.